Hi, this is John McPhee, and I have an example to share with you today about using a covered asset strategy to increase passive income. The easiest way to share this is by sharing the example that I'm going to share with you today. But in a nutshell, what the example's doing, covered asset strategy, is you have a chunk of assets, let's say $500,000, and you want to draw passive income using those assets, but you want to be able to pass the money on to your heirs if something happened to you tomorrow. So you don't want to tie that money up in anything that will be gone if something happens to you. Great example of that is using an annuity to maximize the amount of passive income that you're going to get from that $500,000 chunk of assets. But if something happens to you tomorrow, if you're wanting to maximize the annuity payout, there's going to be no payout to your heirs. So one way to the covered asset strategy can work is by using a life insurance death benefit to cover covered assets, cover those assets in the annuity. So if you do die tomorrow, your heirs get the $500,000 death benefit. But if you live, then you can continue drawing an increased amount of passive income. So let's take a look how that works in a real life example. This gentleman came to us. He was 52 years old. He wanted to retire in 10 years. And he had a lot of money saved, and he had a pension and Social Security, all of those things to count on, but he wasn't sure that he was going to have enough money for his expenses. Here's what it looks like. Let's cut to the computer screen. His estimated expenses 10 years down the road are going to be $85,000 a year. The problem is, with all of his savings and what he planned to save and what he thought the market would do, the orange line now is what his actual income was going to be. So you can see it works out okay for the first 24 years, but after that, he's out of money in his savings and goes just to relying on the money in his pension and Social Security account. And it turns out that this is a problem across America. If we look at the map of the United States, the red states, North Dakota and Massachusetts, people are living on 50% or less of their pre-retirement income. So if they're making $100,000 a year before retirement, now they're retiring, they're living on $50,000 or less per year. The orange states are a little bit better at 50 to 59%, yellow at 60 to 69%, and green 70% or more. The only state that falls into that category is the state of Nevada. So this is a problem across the United States. And the mainstream solution to this problem is to save more, because the markets aren't indicating that there's going to be a very good return over the next few years. A lot of experts in the market say that average return over the next 10, 20 years is looking to be not a lot more than 5%, if that. So saving more isn't really the best choice. And when we look at where people are saving, they're locking their money up where they cannot access it. And that's killing some opportunities that are available there as well. It's beyond the scope of our video today, but those are the mainstream solutions. So what can we do for this gentleman to make it so that he doesn't have to suffer this dip in passive income when he gets to be 86 years old if he's still living? Well, using the covered asset strategy, we were able to make the income go to be the green line. So instead of taking a dip at age 86, it actually increases a little bit to help keep up with inflation. Well, that's a good deal. And so, which would you rather choose, the green line or the orange line? And here's how that works. In the mainstream retirement planning, passive income planning industry, there are two major routes that advisors will take their clients. Number one is they say, well, you should have only investments, because the investments maximize your liquidity and you have the opportunity to earn a lot of money. You can diversify and all of that great stuff. So that's the investment only advisor approach. There's another approach that says, well, you should put everything into life insurance and just use your life insurance. You could take policy loans or withdrawals for passive income, and that is your only strategy. The real answer is that it's a balance of these two, investments and life insurance. And by investments in this balance, I'm not necessarily talking about the traditional market investments of stocks and bonds, although they can certainly include those types of assets. Some of these investments can be investments in your business or investments in things that you were already financing. For example, many people think that they want to go make an investment, but then they have debt, maybe some credit card debt at 12, 15, 20% that they're paying on to the credit card company. Their investments aren't doing that well. So why are they investing when they could be investing that money and paying off that credit card debt first and saving another 12, 15, 20%? A penny saved is a penny earned, and that's the same thing when it comes to interest. So these investments here can be many different things. And the life insurance, of course, is a separate animal. For a long time, we have been advocating that it's good to have a balance of these things that you're working on. We talk about that in the Perpetual Wealth Code and all of our teaching materials, and it's really neat. The research now is coming out and proving that yes, we are right, and we've been saying this for a long time. It's really a neat thing. This is a white paper by Dr. Wade Fowle of the American College of Retirement, talking about optimizing retirement income by combining actuarial science and investments. Actuarial science are things like life insurance and annuities. So diving into the case study that we have for today, the covered assets, this current picture of the gentleman that came to us, he was saving $800 a month. He was age 52, I think I said that earlier. He had a 401k balance of $141,000. He's assuming it's going to grow at 4% until he retires and then go to 2%. And all these are net returns after fees, but he's assuming it's going to go down to 2% because he'll be investing more conservatively at that point to maintain the principal, make sure it doesn't get lost in the market correction. He's contributing $13,000 and some odd dollars every year, plus his employer is contributing another $5,600 in the employer match. And he wants to retire in 10 years. He needs $85,000 of expenses every year at age 62, and that needs to increase at 2% every year to keep up with inflation. Inflation could be more than that, yes, I know, but at least 2% per year for inflation. His expected income from his pension is $51,000 a year. That will be something he can count on, hopefully. And his expected Social Security, $30,264 a year, also increasing at 2% to keep up with inflation. But notice the pension does not keep up with inflation. So he's going to need to make some sort of adjustment to account for that. So the option one that we have here, this is the using his 401k only. This is like the investments only option. It's what most people are doing. So the 401k withdrawals are going to be needed to supplement his income before and after Social Security. Before Social Security because he's not going to take Social Security until he's 65. That means between the time he's 62, when he retires, and age 65, he's going to need to supplement the income there. After Social Security, he's going to need to also supplement the income a little bit because as inflation catches up, remember his pension isn't rising with inflation. So he's going to need to supplement more and more every year from his 401k in order to keep his income where he wants it to be. His 401k at this rate is exhausted by the time he reaches age 82. And he has some extra savings. Remember, he was saving $800 a month somewhere else, and that's depleted by the time he's 86. So not a great picture there. That's why we see that orange line go down. And at that time, his cost of living, adjusted for inflation at age 86, is $137,000 a year. Pension and his Social Security, at that point, are only coming out to $97,579 a year. So there's a big shortfall there. So now we look at the covered assets strategy. And what he does here is he redirects the savings, the $800 a month, to purchase a participating whole life insurance policy for $800 a month for the next 8 years, and then all premiums are offset. That means they're not coming out of pocket anymore, they're coming out of the policy values. So now the death benefit covers the assets in the 401k. So he can take now and use the assets in the 401k for anything he wants to create a better passive income stream, to maximize that passive income stream without being afraid of the fact that if he dies tomorrow, his heirs will lose everything, because now the life insurance death benefit, they'll get that instead of the value that was in the 401k. That's the covered asset strategy at work. So the 401k now at age 62 rolls into a guaranteed annuity, and that creates an income of over $16,000 a year, and that increases every year, 3% cost of living adjusted, and he can never outlive that income stream. Now understand here that I'm not a big fan of annuities by and large, but they do have their place, and this is one place for them. I always like the guaranteed kind, not the variable kind that can change on you. All right, so now continuing with option number 2, the covered assets, the participating whole life insurance policy loans can be used to supplement the income before Social Security kicks in. And then once Social Security kicks in, he's going to have more than what he needs to live on every single month. So the policy loans can be repaid when the Social Security begins until inflation rises to the point where he needs to start drawing extra income again. That will be about the time he's age 79. At that point, policy withdrawals can be used to supplement his income between the time he's 79 and the time he's 86. Remember, at 86, he was out of money in the other option. With the life insurance, he still has over $100,000 left in cash values. And so what he can do at that point, if he needs additional income after age 86, is he can take the remaining participating whole life insurance value and roll that into a guaranteed annuity. He's older now. What does that mean? It means there's going to be a higher payout rate on the annuity. And if he lives longer, then he'll never be able to outlive that income stream. So the payout on that annuity comes out to about $21,633 a year, also with a 3% cost of living adjustment, meaning the payment will go up by 3% every single year to keep up with inflation. And that helps a lot. We're doing 3% here on the cost of living adjustment because that helps offset the pension, which is not increasing every year. So the covered asset strategy extends the income for this gentleman much further, and it provides more guarantees than the 401k did alone. If this gentleman died before he reaches age 86, his heirs still get the life insurance death benefit. If he dies after age 86, well, they don't get the life insurance death benefit because he had to roll that into an annuity, but at least he had the income that he needed to live on. He wasn't out of money. And that's why we can look at this graph and see the income stream as the green line instead of the orange line. And of course, the red line is the expenses that are estimated to be there. So if you found this strategy helpful, that's the covered asset strategy that we talked about today, I have some extra bonuses for you today. We talk more about the retirement curveballs and some of the options in our book, Retirement Curveball. You can find that book on retirementcurveball.com. I'm going to give you a special link where you can go and get some other bonuses with the book today. We have the online book resources. These are also available on retirementcurveball.com. There's an attorney interview, a quick start guide, and a life insurance policy review. We talked about using life insurance in this covered asset strategy. But not all life insurance products are created equal. Many of them I would not recommend for using with the covered asset strategy. So you can get a review of whatever you have. And there are also calculators that you can play around with, figure out what your retirement income or your passive income picture is looking like, see what inflation is looking like for you, and maybe even some Social Security, whether that's going to be taxable or not based on your income level. And then I also want to give you the report on optimizing retirement income and combining actuarial science and investments by Dr. Wade Pfau. That's a little bit more of a technical white paper if you're a techie and want to dive into the details there, or you can contact us and we can work on a scenario for you so you can see what your future is looking like. So to get everything, just click the yellow button on the screen. I hope this video was helpful. If it was helpful or you have questions or comments, please leave those in the comments below this video. And again, click the yellow button to get all of the bonuses I mentioned, the Retirement Curveball book, the online resources, and the white paper. And you can also click the red button to subscribe and get more videos like this.